Okay, let's unpack this. Welcome to the Deep Dive. Our mission is simple. Cut through the noise. Get right to what matters for experienced investors.
Exactly.
Today, we're diving deep into the recent first quarter 2025 earnings call for MidCap Financial Investment Corporation, that's MFIC.
Right.
We're going to give you the essential results up front, then really spend our time digging into the portfolio details, management's take on the market, and what it all means as they keep integrating those recent mergers.
Yeah, these calls are great for getting that direct line into how management sees things, the performance and the landscape they're working in. We'll hit the key figures first and then try to connect the dots on strategy, credit, the outlook, really paint the picture.
Perfect. So let's start with that essential numbers snapshot for Q1 2025. What did MFIC report?
Okay, so they reported net investment income, NII, of 37 cents per share.
Okay.
Annualized, that works out to a return on equity, an ROE of 9.8%.
And GAAP net income?
That was a bit lower. 32 cents per share, so an annualized ROE of about 8.7%.
Got it. And looking at the balance sheet, what about net asset value, the NAV? Where did that land?
NAV per share finished the quarter at 14.93 cents. That was actually down slightly, about 5 cents from the prior quarter.
Okay, just a small dip.
Yeah, and it's worth noting their share buybacks actually helped NAV a tiny bit, give it about a 1 cent boost, offsetting some other pressures.
Interesting. And speaking of the balance sheet, how did leverage move?
It ticked up. Quarter-end net leverage was 1.31 times. That's up from 1.16 times last quarter.
Right.
But they did point out that the average leverage for the whole quarter was lower, closer to 1.2 times. They said that was mostly due to the timing of when deals actually funded during the quarter.
Okay, funding timing. That makes sense. So those are the headline numbers. Let's peel back the layers now and really get into the deep dive on what drove those results. Total investment income was down a bit, wasn't it?
It was, yeah. Total investment income landed at $78.7 million. That's a 4.2% drop compared to the previous quarter.
What was behind that?
Mostly a couple of things. First, lower fee and prepayment income. That fell off quite a bit from $2.3 million last quarter down to just $950K this quarter.
Wow. Yeah.
And second, a decline in the overall asset yield because base rates were lower. Now, the portfolio did grow in size, which helped a little, but not enough to fully offset those other two factors.
Just a base rate impact, it wasn't immediate then. There's a lag.
Not exactly. Yeah, there's a lag. They mentioned that the declines in 3-month and 1-month SOFR that happened back in the prior quarter. That's what really started to bite into their Q1 interest income.
Right.
So the average yield at cost on their core direct originated loans was 10.7%, down from 11% last quarter. And again, lower base rates were the main story there.
Got it. So income headwinds from lower fees, lower base rates. What about the expense side?
Expenses actually came down slightly. Net expenses were $44.4 million, down from $45.1 million.
Okay, what helped there?
Lower management fees, lower interest expenses, and G&A costs were also down. But that saving was partly eaten up by a higher incentive fee this quarter. That was $6.4 million, or about 15.8% of their pre-incentive fee NII.
And they also did a big financing deal during the quarter, right?
They did, yeah.
Huh.
$529 million CLO that closed in February that brought in $399 million of new secured debt at a blended spread of 161 basis points.
And they used that cash
to pay off some maturing unsecured notes. Interestingly, they did mention that at current base rates, the cost of this new CLO debt is actually slightly higher than the fixed rate debt it replaced.
Huh. So maybe more about extending maturities or just optimizing the structure.
Seems likely, yeah. Even if the immediate cost is a touch higher.
Any unusual items in G&A this quarter?
Yeah, other G&A was lower, $1.2 million versus $1.7 million before. This quarter included a reimbursement from Merx, which they booked as a contra expense.
Like a credit back.
Kind of like a refund, yeah, for costs related to that Merx investment that MFIC had covered. Looking ahead, they expect quarterly G&A to average around $1.6 million, plus another million or so in administrative costs.
And the net loss figure reported that seemed mostly tied to specific credit issues.
That's right. They reported a net loss of about $4 million, or 5 cents per share. But they attributed it mainly to existing problems in a few concentrated positions that were already non-accrual, not, widespread new issues this quarter.
Okay, shifting gears to portfolio strategy itself, especially with integrating those mergers. What's the main focus there?
The core strategy is still deploying that capital from the mergers into their target assets. They were pretty active in Q1, actually, made $376 million in new commitments across 33 companies.
How did the pricing look on those new deals?
Well, the weighted average spread was 513 basis points. That was down a bit from the prior quarter. But they also pointed out that the average net leverage on these new deals also went down slightly to 4.2 times from 4.3 times.
And why is that combination important? What's the takeaway there?
Because it means they're getting what they called an attractive spread per unit of leverage. So even if the headline spread is a touch lower, they feel they're getting paid well for the actual risk in that new batch of loans.
Makes sense. And they're also actively selling off some of the assets they picked up in the mergers, right? The ones that don't quite fit.
Correct. They've been working through that, selling certain non-strategy assets. By the end of Q1, those only made up about 2% of the total portfolio fair value. So pretty good progress there.
Okay, so describe the portfolio as it stands now. What's the overall shape?
The total portfolio is valued at $3.19 billion. It's spread across 240 companies, 49 industries they mentioned. They're using GICS codes now. And that direct origination slice keeps growing. It's up to 92% of the portfolio at fair value, up from 90% last quarter.
And what are the key characteristics of that direct origination piece they keep highlighting?
They really hammered a few points they see as differentiators. One, 99% is first lien debt, so top of the capital stack. Two, 92% is backed by financial sponsors based on fair value. So sophisticated equity owners involved. And three, roughly 97% has at least one financial covenant on a cost basis. They stress that covenant quality, especially in the upper middle market where they play, is a big deal compared to, the often cov-light world of bigger syndicated loans. It gives them better monitoring, more control.
How are the overall portfolio credit metrics looking? Holding up okay?
They described credit quality trends as stable. The weighted average net leverage of their borrowers actually improved a bit, down to 5.25 times from 5.5 times last quarter.
That's good.
Weighted average interest coverage was flat at 2.1 times.
Yeah.
Though they did mention that's based on older data from December 2024. It doesn't fully capture the benefit borrowers would have seen from lower base rates in Q1.
Right. That's a crucial point. Those reported metrics always have a lag. The reality for borrowers might actually be a bit better now because their borrowing costs came down in Q1.
Precisely. It's a snapshot. The underlying interest coverage could look better today just because SOFR went down for those floating rate borrowers.
What about non-accruals? That's always a key one investors watch.
That was actually a positive story they highlighted. Investments on non-accrual dropped to 0.9% of fair value. That's down from 1.3% last quarter.
Oh, okay.
They had 0 new non-accruals placed in Q1. Plus, they restored one position back to accrual status after a restructuring, and they got a pay down above fair value on one of the assets from the mergers.
Any caveats there?
They did mention a restructuring after quarter end that will hit the June results, so something to watch for next quarter.
Got it. And PIK income, payment in kind.
PIK income, yeah, where interest is paid by adding to the loan balance instead of cash that actually declined. It was 4.5% of total investment income, down from 5.7%. They pointed out it's still below peers, suggesting most of their income is cash. Though they did say PIK can be okay sometimes.
And they mentioned their historical track record, too.
Yes. They referenced their performance data on loans originated by MidCap Financial, going back to mid-2016, showed an annualized net loss rate, realized and unrealized, of only about 5 basis points.
So they're basically saying, look, our underwriting works over time.
That's the message, yeah. Validation over a pretty long period in different market cycles.
Okay, let's switch to Merx, that aircraft leasing investment. There was an update there.
Right. The Merx investment is currently $185 million fair value. That's about 5.8% of the total portfolio. The main update was around those Russia fleet insurance claims. 4 aircraft involved, 3 still stuck in Russia.
What are they doing about it?
They're actively pursuing legal action in English courts to get paid under the insurance policies.
Any actual progress on getting money back or selling the planes?
They did report some settlements so far, totaling $16.5 million. And importantly, they said they expect a final judgment on the rest of the claims in the very near future.
Okay, very near future is interesting language.
It is. And they use similar language for selling the remaining aircraft, too. Said they've made substantial progress on sales campaigns for most of them and expect updates on signed purchase agreements in the very near future as well. Suggests things might be coming to a head there.
What's the current yield on that Merx investment? Must be pretty low.
It is. The blended yield across the whole Merx position is only about 3.2% at fair value.
Wow, compared to 10.7% on their core loans.
Exactly. which is why they really emphasize that rotating this capital out of Merx and into their higher-yielding direct loans should really help MFIC's future income. They expect Merx exposure to drop in the coming quarters if those sales actually happen. It's a classic capital redeployment story with potential earnings upside.
Makes sense. Okay, moving to the broader market environment and their outlook, how do they describe Q1 and what are they seeing now?
They said Q1 started strong, but then kind of deteriorated mid-quarter. They mentioned things like federal government layoffs, but really highlighted increased worries about tariffs.
The tariff situation.
Yeah, they felt that while some tariffs were expected, the size and scope announced were bigger than anticipated, raising concerns about business fundamentals and, overall economic growth.
But there was more recent development on that front.
Yes, they specifically mentioned the U.S.-China tariff truce that was announced just the day before their call. They see that as reducing the odds of a U.S. recession in 2025.
So lower tariffs are good, but...
But they cautioned other headwinds are still out there. The key issue for them now is how quickly confidence returns among consumers, businesses, foreign investors. And management's view is that's likely going to take some time.
How has all this volatility and uncertainty hit new deal activity?
Well, new issue activity has been pretty light, basically mirroring the slow M&A market. They noted less demand from investors in syndicated loans, banks getting more cautious, and secondary markets getting choppy with spreads widening out. They actually see this uncertainty in the public debt markets as potentially good for direct lenders like them, because the private market can seem like a more predictable, more efficient place for borrowers to get funding when the public markets are all over the place.
That's interesting. So disruption in one area creates an opportunity elsewhere, even if the total number of deals is down.
Exactly. It's a bit of a mixed bag, right? The environment might favor private credit structurally, but the overall lack of deal volume from slow M&A is still a drag on finding new loans. They admitted this uncertainty might just delay that M&A pickup even further.
Right.
Depending on how tariffs shake out, they said it could be a slow year for LBOs, M&A IPOs, which obviously hurts sponsor activity. But they balance that by noting the huge amount of dry powder private equity still has.
Yeah, that pressure to deploy capital.
Exactly, and the pressure to return capital to their investors. That could still push some deals through. They also reiterated they focus on the core middle market, which doesn't really compete head-to-head with syndicated or high yield. And even if big M&A is slow, lots of their borrowers still need financing for smaller add-on acquisitions or growth projects.
Did they give any sense in the Q&A about when M&A might actually pick up?
They were cautious, called the timing path dependent, hard to pin down, maybe late 2025 versus 2026. But they were clear that the PE dry powder and the need to return capital means activity needs to come eventually. They also mentioned some U.S.-specific things like big multi-year spending on CapEx and infrastructure, possibly creating credit opportunities down the line.
Did they give any more color on those 33 new deals they did in Q1?
Yeah, a bit. 19 of those were to brand new companies for MFIC, and 14 were follow-on investments into companies already in their portfolio.
And looking ahead, what about prepayment income? Still expecting it to be slow?
Yes, consistent with what everyone's seeing because M&A exits are slow. They confirmed they expect lower prepayment income and fees in the near term.
They also touched on exposure to government contracts, right? Given some recent headlines.
They did. Said they have limited exposure to what they called stroke of the pen risk, direct reliance on government funding that could suddenly vanish. That's apparently a long-standing underwriting screen for them.
Okay.
They clarified their healthcare deals aren't typically directly reimbursed by the government, and they don't think they have any direct government contractors in the portfolio.
What about exposure to industries really getting hit by those tariffs they mentioned?
They estimated their direct, meaningful impact, exposure from tariffs, is pretty small, single digits percentage of the portfolio. Their bigger concern, and what they think will really drive credit performance, is the second-order effects.
Like
the hit to business and consumer confidence, the risk of a broader economic slowdown because of all the trade uncertainty. That's what they're watching more closely.
Okay. And finally, on credit trends, what about amendment activity? Loans needing changes?
They said amendment activity was relatively flat quarter over quarter. That includes the more involved ones like fixing covenant issues. But they cautioned it's tough to read too much into one quarter's number, partly because Q1 activity often reflects how borrowers did back in Q4 under slightly different conditions.
Right, another lag effect. Okay, let's talk capital allocation. Dividend, buybacks, spillover income.
Okay. They declared the quarterly dividend at 38 cents per share. Now, they did discuss how that compares to the 37 cents NII they earned.
Yeah, pretty tight coverage.
Right. But management said they were comfortable with their ability to increase earnings power going forward.
What was their reasoning?
A few things. One, the timing of Q1 fundings weighted toward the end of the quarter, meaning they'll contribute more income in Q2. Two, they're still operating a bit below their target leverage of 1.4 times, so there's room to add earning assets. And three, that planned rotation out of lower-yielding Merx into core loans.
Makes sense. What about spillover income? Do they have much banked?
Minimal right now, they said.
Yes.
Just as a quick reminder, spillover is basically undistributed taxable income from prior years that a BDC can use later. They do expect that if those Merx sales happen, it will create additional spillover. They'll figure out what to do with it then.
And share repurchases. Were they buying back stock in Q1?
They were, yeah. Bought back about 477,000 shares. Weighted average price was $12.75. Total cost around $6.1 million. And that had that small, about 1 cent positive impact on NAV per share.
How are they thinking about buybacks going forward? Still active?
They said they always weigh it against other uses of capital. Buying back stock versus making new loans or paying down debt if they were already at target leverage.
Right.
They kind of implied buybacks become a higher bogey or less attractive when they're already at full leverage compared to just putting money to work or deleveraging.
Right.
They also mentioned the practical limits rules about how much they can buy each day and when.
Okay, so let's pull this all together. For an experienced investor listening, what are the key takeaways from this whole deep dive into MFIC's Q1 call?
Yeah. Well, if you connect the dots, it seems MFIC is really executing its main strategy, using that merger capital to ramp up higher-yielding direct loans sourced via their affiliate, MidCap Financial. And they're doing it while still running slightly below target leverage, so there's capacity to grow more.
And the way they're building the portfolio seems quite deliberate, given how uncertain things feel out there.
Absolutely. That focus on first lien, floating rate loans, mostly in U.S.-focused service businesses, less cyclical industries, plus the covenant protection and being the agent so they can monitor closely, that all seems designed to be defensive in this kind of macro environment.
It also sounds like the trouble in the syndicated loan market might actually be helping direct lenders like them, even if overall M&A is slow.
That's a key dynamic they pointed to, yeah. The tariff worries, the economic uncertainty, it slowed M&A and made syndicated markets jumpy. That can make private direct lending look like a more stable, reliable option for borrowers. So opportunity for MFIC, even if the total deal pie is smaller than it was.
And the existing portfolio seems to be holding up reasonably well.
The stable credit trends, that slight improvement in borrower leverage, the drop in non-accruals, those are all pretty positive signs about the health of the current book, even while management is rightly keeping an eye on those potential second-order macro risks.
Plus, that ongoing cleanup of non-core stuff should help over time.
Right. Getting rid of Merx and those other non-direct loans they acquired should gradually lift the portfolio yield and the overall income as they reinvest that cash into their core strategy. Those near-future comments on Merx are definitely worth watching.
Okay, here's where we get to have a bit of fun.
Yeah.
Let's pivot to our This Is Not Financial Advice segment. We're putting on our imaginary analyst hats now, pitching a couple of, let's say, wild yet plausible trade ideas based only on what we heard in this call. Like, we're brainstorming for an investment committee. And just to be absolutely clear, this is not investment advice. These are just thought experiments, okay? Derived solely from the call data and commentary.
Think of it as sketching out what-if scenarios based only on the pieces they gave us on the call, nothing more.
Exactly. Okay, trade idea number one. We'll call it the portfolio optimization play. So the call really focused heavily on MFIC rotating capital out of lower yielding stuff like Merx, remember, 5.8% of the portfolio yielding only 3.2%, and other non-core assets, which are down to just 2% now, and rotating into their core direct loans, which average, 10.7% yield?
Right. And they also brought up that historical track record for MidCap Financial loans, that tiny 5 basis point annualized loss rate since 2016.
So based on all that, you could build a case around MFIC significantly boosting its earnings power as this rotation finishes.
So the theoretical idea is, go long MFIC common stock. The bet is purely on NII per share expanding as they swap lower yielding assets for higher yielding ones, potentially with good credit performance. This play gets really interesting if those Merx sales happen in the very near future and they successfully redeploy that cash.
Right. It's essentially a bet on management executing this cleanup and redeployment strategy effectively over the next few quarters, driving better portfolio quality and income.
Okay, trade idea number 2, the leverage boost and dividend coverage play. So MFIC ended Q1 at 1.31 times leverage, which is below their 1.4 times target. Management explicitly said they expect strong fundings in Q2, which should push leverage up. And crucially, despite Q1 NII only being 37 cents versus the 38-cent dividend,
Yeah, not that tight coverage.
management expressed confidence they can cover it going forward. Based on that funding timing benefit, operating below target leverage now, and the Merx rotation we just talked about.
Okay, so pitch the trade idea based on
A
this.
hypothetical trade, again, maybe long MFIC common stock, or perhaps looking at call options expiring, say, late 2025 or early 2026. The core anticipation here is that NII per share will visibly increase in Q2 and beyond, driven mainly by hitting that higher leverage target, assuming spreads and rates cooperate.
And the payoff.
If that higher NII clearly shows strong, sustainable dividend coverage, it could maybe lead to the stock's multiple expanding as investors get more comfortable with the income story, or possibly even set the stage for a dividend increase later on, so it's aimed at investors looking for income stability and potential growth catalysts.
Got it. So this idea leans into the near-term operational levers, higher leverage, funding timing translating into better NII that solidifies the dividend narrative.
Precisely. And again, just conceptual ideas spun out from the call details, not recommendations.
Absolutely. So to wrap up this deep dive on MFIC's Q1 call, we saw solid NII driven by portfolio growth, even with some yield and fee headwinds. Credit quality looks stable, maybe even improving slightly in the core book. Clear progress on rotating the portfolio and using that merger capital. And management sounds like they're actively navigating the uncertainty while still seeing structural advantages for direct lenders.
And remember, as always, this was just for informational purposes. It doesn't constitute financial advice. We've just tried to distill the key themes and potential implications from their earnings call.
Definitely. So as you continue your own research based on this information, here's something to think about. In this current market where M&A is slow, syndicated lending is choppy, which specific part of MFIC strategy do you think is the most important differentiator for them right now? Is it their focus on those covenant-heavy first lien loans? Is it their ability to act as the agent on deals? Or is it maybe this active capital rotation out of lower yielding assets?
Yeah, which one really matters most in this environment? Something to ponder as you dig deeper.